Building wealth is often presented as a simple formula: earn more, invest early, stay consistent. But in Nigeria, the reality is far more complex. Inflation erodes purchasing power. Incomes can be volatile. Currency risk is ever present. And policy shifts can change the environment landscape overnight. In this episode, we focus on building sustainable wealth long term in Nigeria. Actually, in focus, what does this mean? So today, we move beyond generic advice to examine income foundations, asset allocation, risk management behavior, and the discipline required to build wealth that lasts across economic cycles and even generations. I'm delighted today to be joined by Adura Ojo. Adura Ojo is a chartered financial analyst and a chartered accountant. I'm beyond pumped to welcome you to The Edge, Adura.
Thank you, Doctor, for having me. It's a privilege to be here. Yeah.
It's my pleasure. Welcome. All right. So obviously today we are talking about building long-term wealth in Nigeria. Wealth is often discussed aspirationally, but definitions matter because they shape how people save, invest, and take risk over time. When you talk about long-term wealth with Nigerian clients, what does that actually mean in practice? I'm talking about practice now, not in theory.
Okay. From my experience with clients, Nigerian clients, what you discover is that people are interested in something that can sustain them beyond, their retirement.
Yeah.
You have these categories of clients. You have the business class, categories of clients. These are people who are educated, they are working, and these categories just want they want to be able to maintain life after retirement. So their goal, what they see as long term, is the ability to have some savings and something to maintain their life after retirement. For those individuals who made their way through active or business venture, or what you can look at through entrepreneurship. So you discover that. So for those categories of clients, is what they look at is the ability to be able to, sustain that business from, one generation to the other. But generally, when you talk about long term, now not within Nigerian context. Within Nigerian context, yes, it's just for me to be able to maintain life. After that, nothing else. You get so. But beyond that, generally speaking, when you talk about long term wealth, is that wealth that should be able to, that should move from one generation to the other. But when you also look at the statistics
across different cycles,
yes. But when you look at statistics globally, it's not really very interesting, right? Because like statistics will show you that about 72% of business owners don't even have. They don't have any formal business business continuity plan in place.
So and how do you move from one cycle to the other if you don't have a continuity? You don't have that plan, that succession planning, which I imagine is key to creating long-term wealth.
Now, so the problem that creates is that you now have wealth that cannot be sustained beyond, the second generation. So you have just like 30%, 30% of wealth are able, statistics are showing that only 30% of wealth are able to move from the first generation to the next generation. Then you have 12% to the third generation. Then you now have only just 3% beyond. These are global statistics. And what does that tell you? It's not a phenomenon that is limited to Nigeria, but to actually manage that, it means that there should be somewhat a mindset change, right? People should start to change their mindset about what
Building
long-term,
long-term wealth means.
yes, what it's all about. So when you understand what it means to be able to sustain your wealth from one generation to the other, then you can now begin to engage the services of financial planners to be able to help you to manage that. Without that,
Okay.
it will be practically difficult to be able to transition wealth from one generation to another.
Okay, thank you for laying that background, because I think it's going to be important for us as we continue to discuss on this topic. So Nigeria's economic environment introduces unique frictions that are often missing from global wealth narratives when we talk about building long-term wealth. And you actually started off by giving us that statistics of people or businesses or individuals who own businesses that are able to pass them across generations. So Nigeria's combination of persistent double-digit inflation, frequency policy U-turns, forces households to fight an uphill battle just to be able to preserve what you already have. So within Nigeria's economic reality, we have inflation, income volatility, and policy somersaults. What makes building long-term wealth particularly challenging for the average household in Nigeria?
Well, just like you have said,
Yes.
Economic variables, what it does to your ability to manage long-term wealth is the fact that introduce a lot of uncertainties, right?
Mm-hmm.
So uncertainties like you are now moving from growing your wealth to wealth preservation. So that you now begin to move from here to here. So instead of you being able to save, then you are now migrating from wealth generation to wealth preservation. So to be able to deal with these challenges as an individual investor, or you must have that education, financial education, to be able to know that. Of course, it's not a given that you must have that education. You can, for you to deal with it, you need the services of advisors to be able to weather the storm. Because when you have advisors, knowledgeable advisors, and people who have competencies in managing wealth, of course, what it helps you to do is that they take you through these market vagaries. So the impact on your ability to be able to maximize your wealth will be minimized. So of course, when you also look at Nigerians, you look at individuals in Nigeria, because of the complexity. In fact, it's beyond even the macroeconomic variable. You have structural issues, insecurities that make savings, very difficult. People living from hand to mouth. So when you have poverty around, it's a challenge. It will have been sufficient if the challenge is limited to economic, the policies, variables. But when you now have other structural problem, it creates that problem of inability to save. Then it creates the problem of flying to safety. Then you want to, Nigeria is not, the environment is not conducive for investment. How do you move? In fact, even for the business class, and for the business owners, the entrepreneurs too. You see all these challenges coming. So it makes it a bit very difficult. So but when you have knowledgeable advisors, they can
Yeah.
help you to, I mean, to manage this,
To be
I
able
mean,
to navigate
uncertainties. Yes, to
all
be able
that.
to navigate this. So that's
Yeah. I mean, it's not something I think many people actually pay attention to in Nigeria. I think a lot of people just believe, okay, let me do this business, make some money, acquire one asset or acquire the other, and they just believe that that's going to be enough to pass to the next generation. But I mean, you obviously engaged in this. You've been, helping the 1% of the Nigerian elite to manage their wealth in the last couple of years. So many wealth outcomes are usually driven by income levels and more by mindset expectation. We already touched on that earlier. So social media and peer pressure have conditioned many young Nigerians now, many young Nigerian professionals to chase visible symbols of success rather than the quiet mechanics that actually build wealth. So, what is the biggest mindset mistake Nigerians make when thinking about wealth, especially talking about young professionals now?
okay. Thank you, Doctor. Is when you look at Nigerian, I mean, young professionals, um, these are a set of people that want to make it quick, right? They don't want to believe that um, wealth wealth management or creation is a journey. It's not
Yeah,
an
it's not
end.
a sprint.
It's not an end in itself. You must
Mm.
have a goal.
Okay.
You must start early. You must be consistent. You must be consistently invested in the market or whatever it's a business endeavor. You must be there to weather all the economic uncertainties around that business. Because one thing is sure is that at a point in time that you are entering into any business venture, you are going to meet incumbents, right?
Sorry,
So,
Adura. Let me.
okay,
Sorry, you mentioned that world generation requires you starting early, and a lot of people who are watching this might be thinking, "What do you mean by early?" I mean, given the Nigerian context.
okay. For instance, if you
Yeah.
are if you are if you are doing client categorization, you have the foundation phase, right?
Mhm. Mm.
That foundation phase, you are acquiring, I mean, marketable skills
Yes.
that can fetch you some returns,
Mhm.
uh, for business owners. Of course, you have to also, if you want to be a business owner, you have to start early. And
Yeah.
when you start early, you can, any business that you are doing within a period of 5 years, because statistics will also show you that if you start a business within 5 years, you might not break even, right? So if you delay, if your path is entrepreneurship, if you delay until you attain certain age, maybe the age of 50, to start that journey, might be, and if in fact your risk appetite, your ability to even cope might be very very difficult. Then also, if you are in the business, I mean the middle class workers, being paid employment, and also, so you need to start saving, you know, towards investment as early as possible, because investment is a long-term journey. And when you look at the market, when you look at the financial market, you look at, for instance, you
Yeah.
look at the equities market, look at it
Mhm.
between 2005 and
Yeah.
now. The all share index has grown from about 24,000, right, to 165,000. You know what that means?
That's significant.
That's a lot. But when you look at volatility in between, so you see the mindset now is that I want to make it quickly. Oh, what are those level of returns I need to make? In fact, like last week, there was a client that I was talking to, and this guy even reside outside the country. The guy was looking for an investment that will return 100%, 160, 200. What can I do? What kind of stock can I buy
That's
to
fast food
deliver?
mentality of wealth
Do
creation.
you understand? So these days, wealth management is even going beyond. It's no longer within the scope of just the normal portfolio management that we used to do. Portfolio management is to say, oh, you know what, your portfolio manager uses, maybe if it's a discretionary portfolio management, they are using their skill to manage it for you, just to grow. They will tell you the objective is income and capital appreciation. But these days, it's going beyond that. So it has to be goal based. You must set a goal. What do you want to achieve? So when you set those goals, then consistently you now start that journey to actualize those goals, those financial goals. So that is why it is very important that you start early. And that mindset, the Nigerian, the professional mindset, that mindset has to change. It's not wealth management or wealth building is a long journey, because it starts from you create.
Yeah, I agree with you. I think maybe this social media age is even complicating issues. But I wanted to also ask you this. Some wealth philosophers, or that have actually postulated different theorems as to how to build wealth. Obviously, we have within the Nigerian context, we have philosophies as being propagated or pushed by the likes of Tony Elumelu. So Tony Elumelu emphasized building systems and ecosystems rather than chasing after short-term gains. Obviously, he used to be the MD of UBA. And he currently hosts heads a lot of different organizations. So Tony Elumelu has advocated moving beyond short-term trading, which I think is the perception that most people have in Nigeria, to making deals that are targeted towards building an ecosystem, generating an enduring value, an approach that could also transform how Nigerians actually approach personal and family wealth. So, drawing from these blueprints from Tony Elumelu, how do you think that building this building an ecosystem that would help simplify the way in which assets are accumulated, rather than just having this trader mentality that most Nigerians have?
Well, just like I said earlier on.
Yes.
It's about number one. It's about having a mindset shift. Once you have that mindset shift, and you know that wealth creation is not an end in itself. It's a journey on its own. Yeah, then it means that you are mature enough to go that long haul. So instead of now looking for that get rich quick, avenue to make money, then you start early to now discover that to navigate that path, that trajectory requires consistency, right? You have to be consistent. You have to have mentors, right? People that have done it before. So when you have those guys by your side to also take you through that journey, of course, those are necessary prerequisites to helping you to even build whatever you want to build. So, and when you are even an entrepreneur, whether you are in paid employment, it also means that you also need to be looking at other sources, right? You are not looking at just one single source of earning income. You need to create multiple streams, for yourself, because the mentality, at least for young professionals, is that once you have that education, after the college education, the next thing is for you to, you get paid and you are working, so you are looking at your career. Oh, by the time I grow to this senior level, it's beyond that. If you are looking to grow your own wealth, then you need to look beyond that. You need to be looking for other income making, avenues to be able to to build wealth and to be able to sustain your, because even employment, if you are in a paid employment that is more correlated with the economy, for instance, you are a stockbroker and you are working in the, you are a stockbroker. You can imagine the stockbroker. A stockbroker, your role as a stockbroker, you are in the financial market. In fact, you are very correlated. Your experience, your knowledge, your skill is correlated with the market. So
you are exposed to
any,
the market.
you are exposed to the market. Any downturn in the market will also hit you. You understand, like what happened in the past, where even
Yes.
stockbrokers could not pay salaries and some of those things. So these are the things that individuals who want to build wealth, who wants to. When you even look at the person you reference, Tony Elumelu, you look at these people, they are also diversified, right? You have diversification. It's part of it. You cannot.
Before we look at diversification, I still want to stay with you on income, savings,
Okay.
and that being the foundation of wealth. So without rock solid personal financial basics in place, even the best environment ideas can collapse under the weight of maybe an unexpected emergency or income disruption, as you mentioned. If you work in an environment that is highly correlated, with what is happening in the market, that is common realities in Nigeria. So before investing, what financial foundations, because I think it's critical, what financial foundations must realistically be in place? The income stability, multiple income streams, emergency funds, and insurance. What foundations must realistically be in place before we can even start talking about investing? And if you may, because I know that most Nigerians have just one job. You hardly find Nigerians with multiple jobs, which is what you see in other economies. So please go ahead.
Well, it depends on how you are starting. If you are in the middle class or if you are in paid employment,
yes,
of course, you have to go through the foundations, right? You build your skills, your marketable skills that can earn you returns over time.
Yes.
Now you have to start with that. Then with that, you have program savings. You have to create the habit of saving. It is when you have a long period of sustained saving that you can now begin to think about investment, right? Then also as an entrepreneur, well, let's not even go into the challenges of raising capital to start a business, right? So what I know is that if you have any plan to start a business, you can start as early as possible, reaching out to friends to raise capital to do your business. So over time, if you create that habit also to have relationship with financial institutions, these are things that can also support you to be able to so those are really necessary foundations that you have to lay, so that over time you continue to build on that relationship, and as you grow along, then on the business side you can now embark on long-term borrowing, to business expansion drive and all sorts. But on the other side, you don't need to bother yourself about having an emergency fund first. For instance, start first. So when you are getting to a certain stage in life, that is when you now have to have all those create those plans to be able to have something like insurance, risk management. Those are just risk management. You can't start from risk management. Start first. When you start first, you start to you have savings and you start to invest, you start to build, then over time you could now be looking at how you can manage the risk, where insurance comes in, then where you have emergency fund in case something happens. What happened within the next 6 months? What if there is a volatility or something happens here? So even beyond that, then you have a period of economic crisis, economic volatility. In fact, in a period of high inflation, you discover that you also need those emergency funds to be able to deal with certainty, the uncertainty. That is where those come in. Those cannot be your immediate concern when you want to navigate or you want to go through the wealth building trajectory. So what you do is create that saving habit, be consistent, stay invested. Don't short-term market. In the long run, what you discover is that the market will smooth out. So, but over time, so if you are riding on the curve, you just want to ride it and you come down, of course you can be wounded, you can be injured, and that is that is what it is.
So you just talked about savings, and obviously when inflation routinely outruns interest on savings accounts, many will feel trapped in such savings. So if you hold cash and you watch it lose value, like we've seen over time, we've seen the exchange rate move from about 190 or 200 naira to a dollar to about 1,400 where we are today. Or you also invest aggressively and risk big losses. So in a high inflation environment, how should individuals balance savings versus investing? Right? How should they balance that? Looking at how much should be saved or how much they could invest, especially looking at a high inflation environment. You keep your money in like a savings account. Inflation is higher than the returns that you are getting.
Okay, one thing, inflation is not generally that, it's not bad generally, right? Depending on the type of inflation. Well, markets are also becoming somehow integrated now. When I say integrated now, correlation so between markets has been increasing. Then you are also seeing something like a contagion effect from other markets to domestic market that can also impact inflation, that can create that volatility. For instance, I will go to your question. I just want to
I understand. You go ahead.
Yeah. So, like when you look at what is happening between, the Russia-Ukraine crisis, the destruction that war is creating is trickling down locally to create local, inflation, right? So when you look at it, you will ask yourself, where do I go? Is it the time to fly to safety, or where do I go? Depending on your exposure. If you even have exposure to those markets, it also creates another problem for you. So to deal with inflation, in a period of inflation, you can have asset prices to become depressed, right?
Yes.
What cash buffer does for you is that there are some assets that inflation will help. For instance, if for equities, if a stock, or a company cannot pass through inflation into their prices, it means that, of course, you are going to see their stock depressed, right?
Yeah.
So that can happen. So when that happens, as an investor who has cash buffer, because it's very, very important that you have cash buffer during inflation, so that you can take advantage of depressed prices in the market, because that market you are seeing is just a temporary dislocation.
So you believe that it's important to hold a portion of your assets in cash.
Yes. Another thing is this. During inflation, normal monetary response from CBN will be to do what? To increase interest rate to tame inflation. So most times, what you can do is to be able to, if you have good advisors and they can help you to optimize your cash. So that time you see yield on treasury bill. Treasury bill might be a very good investment. The yields of treasury bill will go. In fact, in Nigeria at a point, this country went to as high as 24%, even though it was a bit it was still lower than the rate of inflation, but it was somehow close. But you can time yourself to ensure that at the point that the market is about to turn, you take advantage of that high yield, because when market begin to turn, you discover that you are going to make appreciable gains on your cash. So during inflation is not that, it's not inimical to cash. I mean, fully. That's what I'm trying to establish here.
Okay.
That having a cash buffer, you understand, can also help you to navigate a period of inflation, because you can take advantage of depressed, prices in the market. So these are ways through which you can manage, you can hedge, inflation. In an inflationary environment. So.
Okay. Thank you. So let's switch gears a bit and talk about asset allocation and investment strategy. So asset allocation is the backbone of long-term resilience, especially in like volatile economies. Long-term resilience in Nigeria would demand that you have thoughtful diversification. I think you already started talking about that earlier. You have thoughtful diversification of your investments across different asset classes, while also factoring the country's unique inflation, currency, and regulatory dynamics. So, how should Nigerians think about long-term asset allocation across equities, fixed income, real estate, alternative investment, and emerging digital opportunities to remain resilient across different economic cycles?
Okay, well, the way the wealth management industry is also changing. It's also, something that one should also refer to. You have, just like you mentioned, you also have regulatory, you have tax issues, you have,
Yes.
you also have data privacy issues. You understand that these are things that these are changes that are also happening in the industry. So data privacy, of course, when you have those markets, you have regulations, you have all those, and you want to stay diversified in some of these markets, then it also shows that you have to think twice. You have tax issues, right? So you need professionals to be able to help you to navigate, some of these.
Given these recent tax reforms as well, so I think that's important.
Yes. So when you are diversifying, internationally, then you have to consider some of these factors before you begin to do your asset allocation. But one thing that is most important is that, what is your goal? What do you want to achieve? So depending on the complexity or the level of your wealth, because the level of your wealth will determine the complexity of the kind of advisory that you will seek, right?
Okay.
If you have asset globally diversified, then you need a combination of advisors. You have the tax expert, you have this one. Of course, your wealth manager is expected to be able to bring all these, team specialists together to be able to help you to navigate, some of these things. So, but all I'm trying to say is that you need to look at some of these things before. You need to have a goal. What is your goal? By the time you are profile and you know what you set to achieve, that your goal will inform the kind of asset allocation, whether it is equity. But it's not something that is that straightforward. There are so many criteria. So many factors one has to consider before we even begin to say, okay, how do we allocate assets? Do we have local domestic market concentration, or do we diversify globally, or do we have global equities in your portfolio, or do we have global fixed income in your portfolio? So your goal will help your advisor to be able to do that. So once your goals are established, then to be able to do that asset allocation will be very easy. Then if your wealth is not that it's not that complex, you don't have it spread across, of course it also makes it a bit easier for you to have the not too complex advisors, which you have to also pay. All these things also have costs. You have
Yeah,
costs
I
to
know.
advise.
I know you relate and talk to the 1% of the elite in Nigeria. But I'm talking about, or I'm asking about young professionals who have aspirations, okay, to
Okay.
also get to that level. I obviously agree with you that depending on the amount of work that you have and your goal, that would determine the prescription that your wealth advisors like will give you as your doctor, so to say.
Yeah.
So let's talk about the the role of maybe investing in foreign denominated assets, or maybe investing locally. So because the naira historically has experienced a lot of depreciation. Um, at least we've seen in the last couple of years. So the naira's history of depreciation has made dollar-based assets a de facto hedge for many wealthy Nigerians. I'm sure you would agree with me.
Yeah.
Yet, all in on foreign holdings can also mean that you are missing out on local opportunities. How do you see this?
Yes. Of course, you having foreign assets will give you some benefits, right?
Mm-hmm.
It's also exposes you to some risks. So
Yes.
what is ideal here is to create a balance.
Okay.
Well, depending on what you want to achieve and your risk appetite, well, you can decide to be concentrated locally when you have a split between foreign and domestic markets. You can decide to concentrate locally, or you can decide to have a greater exposure to foreign markets. What the local portfolio, the domestic market asset, what it helps you to do is to be able to create a level of stability, in your portfolio, because that will not be subject to market volatility or exchange rate risk. When I say exchange rate
Okay.
risk now, I not, if you are for instance, if a Nigerian investor is invested in Ghana, do you understand?
Mm-hmm.
This is a sub-Saharan African country. You are not even moving beyond the shore of Africa. It's times as you are investing internationally, right? So
Sure.
in that kind of market, those kind of markets they are whether they are classified as a frontier market, the kind of market they belong to now. Now you discover that the risk is actually very high. The risk premium that investor will seek to invest in those markets are actually very the risk premium is very the risk premium is very high, very very
Yeah.
high. So when you want to create exposure to those kind of market, you have currency risk. You understand? Then
You need to
what
pay
knowledge
attention
of
to
the
currency
local
risk as well.
yes, what knowledge of that market do you have? Do you understand? So investing locally, you understand the terrain. In fact, it will help you to be able to take advantage of some, because you know your terrain. You can take advantage of what is happening in the market, and if prices
Yes.
are not aligning, and you are having an arbitrage opportunity within your domestic market, your that portfolio will help you to achieve that, even without without you don't have to, without you being what I'm trying to say now is that you are not fully invested in one market, right? So the local portfolio will help you. Then your foreign portfolio can also expose you to some decent returns that your local market cannot provide. And that
then
foreign,
provide some preservation of your capital,
yes,
especially
in terms
during
of,
when naira depreciates.
in fact, that one is also a function of the correlation.
Okay.
It depends on the level of segmentation and integration of the market you are investing into. For instance, if you are investing in the US market, right?
Mhm.
You know that that market is a bit somehow correlated with Nigeria. You know why? Because Naira, we do a lot of import from that market. So in
Yes.
fact, the local currency is reference to that currency, right? So whatever happens in that currency, whatever happens to that currency will affect your currency. So you have exchange rate, risk there. So if you are investing in, of course, if you look at the trajectory, investing in the USD, you discover that over time, look at it from even since 2023 up to now, you know by how much the naira has depreciated over time. But it's not, that trajectory is not going to be the same across currencies. You have some market that you are not going to have that kind of level of depreciation, right? And
So,
such, so that,
Adria, what I'm hearing you say now is, so even when you are choosing whether to allocate your assets locally or to have some foreign portion of your assets in your portfolio, you need to check the correlation of your
yes,
economy and the Nigerian economy and that other economy, because
yes.
otherwise you just be investing in an asset or within the same um, product that are highly correlated.
Yeah, you know one benefit of diversification is that one key thing about diversification is that is correlation.
Uh-huh.
Correlation is co-movement. If your asset, if I have asset that move in along the same line with
Yes,
another asset, it means that when things are good,
they
things
move
will
in
be
the same
better.
direction.
They move in the same direction. When things are bad, then they move in the other direction. So that correlation is the key factor that you consider when you want to diversify into any. So those are the things you consider. Then that will help you to make your asset allocation so that you allocate in such a way that when you are through with your allocation and you want to be sufficiently diversified, you discover that by the time you look at the correlation, you discover that so those assets will be moving different
In
direction
different
when,
directions, so that you are not
yes,
overly exposed.
exactly. So these are considerations that you have to make before
Oh,
you start to do your asset allocation.
okay. Yeah, I think I understand that, because I was expecting you to give me percentages, but I think I get it better now that
Yeah.
it is not about just giving percentages of allocate
Yes. Yes.
20% here, allocate 30% here. It goes deeper. It
Yeah.
goes deeper than that. Okay. Now, let's talk about real estate. Real estate is culturally viewed as the safest store of value, yet market dynamics are changing. So, given the projections of steady growth in Nigeria's luxury real estate market, driven by diaspora inflows and the limited prime supply that we have in Nigeria, what factors such as sustainability, cash flow, long-term appreciation should investors consider when using property for wealth preservation?
Well, the first thing I would tell anybody who wants to invest locally is to ensure that you do it right. Right.
Okay.
When I say do it right now is that
Yeah, I want you to expatiate on that.
so it's not just about getting or banking on the information that if I invest here it's going to appreciate, it's going to be. Real estate has its own nuances, right? Depending on
Yeah.
your stage of life, will also determine how much you stay invested in some of these low liquidity asset classes. For instance, yes, if you have investment in real estate in Nigeria in choice areas, I mean areas where marketability of that property will be very easy, right? Yeah, it might not be really too but there are also other factors like the nuances. The market is not that transparent, right? So which was why I said you have to do it right. The market is not that transparent. There is no unified platform for you to
Yes.
have exposure to real estate, to that market in Nigeria. So you have to depend on individuals, to gain access into that market. So that's, and also that real estate is capital intensive, depending on where you want to operate. If you want to invest in commercial properties, for instance, then it means
Yes.
that you must have the capital to be able to do that. And are you on ground also to be able to manage some of these assets, because they are income producing assets. Those income producing assets, they are also alligator investment, because they will take from you. When they want to take from you, they will take, because the way properties are used here, let me just be lenient a bit. The way when you see residential properties, the way renters use properties, they use and move to another locations, then you discover that the cost of renovation might even outweigh, all the
The
revenue stream
benefits that you derive,
yes,
the cash flows you got from them.
that you derive, right? So most time you also have challenges around this lack of transparency I'm talking about. That you invested in properties does not mean that today that cannot be, other issues cannot arise from it, right? So which is the reason why when you want to do property investment in Nigeria, make sure you do your due diligence. It's very, very important. Get it right. Yes, the possibilities are enormous for capital appreciation,
Yeah,
right?
okay.
But when you want to exit is also is also very important when you are planning some of these things. When you want to exit, at what point do you, if you have a goal, between when and when do I want to stay invested in properties? Now, when you know your time horizon, then that will help you to plan, so that before that time, you also have other plans to be able to take care of some liquidity gap should you are not able to exit that property. Maybe, I don't know, for now there is no market where properties are listed where you can easily, of course you have documentation issues and some other things that are
Yeah,
inherent.
where you can see different properties
Yes,
listed for sale.
yes,
Yeah,
listed for sale. So that
I understand what you are saying. I think it's also important to stress this. You already talked about the liquidity and marketability of those properties. So
yeah.
it is not about you seeing one piece of land in a remote area and then investing your hard-earned money on that, and then you expect to be able to generate, be able to dispose that asset whenever whenever the need arises. So, as I say in real estate, location is key when you are looking at purchasing properties. But Adria,
Yeah.
we'll move from there and talk about the elephant in the room, which is the foreign exchange markets and preservation of wealth. So currency risk is one of the most persistent and I would say emotionally charged challenges in Nigerian wealth planning. So foreign exchange risk is one of the most consequential variables when we are looking at wealth planning in Nigeria. So how should Nigerians think about currency risk when planning for long-term wealth?
Okay. Let me say this. At a point, I began to blame analysts, right? For
Why?
not, yeah, for not properly, educating investors.
Okay.
When you look at we are talking about currency risk now, right?
Yes.
Because you see some individual investors that want to stay invested in, for instance, Eurobond for a very long time, a
Yes.
protracted period of time, right?
Yes.
Simply because over time, by the time you look at the trajectory, you discover that Nigeria, the exchange rate has depreciated over time.
Yes.
Over time. So of course, when you look at that statistics, if you don't look at it, if you don't take a second look at that statistics, then you make that mistake. There are some assets that deliver returns beyond, currency returns, right? What you call currency return is the exchange rate risk you are trying to manage. So when you
Yes.
manage exchange rate risk, it will deliver you currency return. When you invest in foreign assets, there are two sources of return. You earn the return on that asset, then locally you earn that exchange return, which is the hedge that you are
Yes.
that you are trying to create by investing in by creating that by managing your currency risk. I would just it's not 100% true that you stay invested in currency. When you look at the market, the Nigerian market, for instance, you look at Fidelity stocks in 2008 that was trading at 80 kobo, right? And now Fidelity is doing around 20 naira. How do you, if you measure that return by yourself,
Yeah, by in
doctor,
terms of exchange rate, yeah.
and do you understand? If you look at that level of return between 2008 and now, you can imagine how much that stock has delivered compared to between exchange rate in 2008 was about around 360, and now it's about 1,500. That's like 500
Exchange rate in
percent.
2008 was below that, Adura. I think was maybe about 100, 120
No,
or
no, no, no,
100.
no. In 2000, in 2000, no, 2018. I mean, sorry,
Okay.
I meant to
Okay.
say 2018.
Okay.
In 2018, Fidelity was 80 kobo, right? Today is 20 naira. So that's more than over 1,000%, right? So when you look at that, that's some. What I'm trying to establish here is that yes, having foreign exposure will help you to hedge some of this, but there are some domestic assets you can invest in, right? That will deliver superior return. That will even over and above what currency exposure will also give you. That is not to say it is not a vital part of your portfolio, depending on your goal, right? So it can help you to manage some of the, most especially when in a period of economic crisis, people fly to safety. It might be a
Yeah.
period you want to stay invested in commodities like, the yellow metals like gold, right? You can gain exposure to some gold ETFs and also to help to protect yourself. Yes, it's good to stay invested for protection too, in a period of economic crisis. So that will help, but that is not to say that if locally you can get good, if you can get good advisor that can help you look at some of these asset classes, you can even get some superior return that will outweigh what you get from. In fact, for even fixed income, let me shock you. For fixed income, when you do some simple calculation. Even now, as at before, when yield on fixed income was around 24%.
Yeah.
Some of those bonds were. Yes. I saw 22%, right? Like
Yeah, there
20,
were bonds
yeah,
that
yeah, like
were
yeah,
issued at 22%.
last year. So at that time, but if you do the mathematics and you discover that at that point, you need to look at the outlook on exchange rate. That will help you. So the outlook on exchange rate was showing that, okay, we are having fiscal discipline locally, right? The government is
Yeah.
doing a lot of fiscal reform, and some of these fiscal reforms
Mm-hmm.
start to help the market, whereby we see the exchange rate strengthening. So when you have that kind of, direction, then what that helps you to do is to be able to look at the naira assets, the naira side of it, so that that can also because those are the things that will now help you to be able to know that, oh, okay, when things begin to change, this is most likely going to deliver superior return than this. So for those fixed income instruments, if you do that mathematics, you discover that the return you are going to make by just staying invested in bond, even for a period of like 5 years, even if exchange rate moved to 2000, the projection we did was if exchange rate moved from with its level currently to 2000, and you stay invested in fixed income, you discover that you'll be better off.
Yeah, I think I did some of those analysis as well. Then I think a lot of people I would consider noise over the issue of exchange rates, currency risk, and all that. Because actually, when you look at some of those fixed income instruments, that bond that was issued, I think about 22% for about 10-year period. You can imagine the amount of returns, coupon that you're going to earn on it on a yearly basis for the next 10 years, and what your return is going to look like compared to the exchange rate volatility that people normally like to talk about. So let's move on and talk about wealth destruction. So wealth destruction often happens quietly through, people's attitude to wealth preservation. So what are the common ways people unknowingly destroy wealth, especially during economic shocks?
Yes. So during economic stress, what happens is that you see people try to fly to safety. That is what is called decision risk, right? Decision risk is when you panic sell when assets are, in fact, at the point of the maximum loss. You are putting pressure on your advisor to dispose of the assets, even when you should be taking advantage of the market, right? Because when you are able
to, it's difficult. We're all human beings, and our emotions run. When there is this economic shocks and all that. You'll notice that sometimes people buy assets. Let's say you purchase a particular security, and the price has declined by about 20 or 30%. You won't see that same individual go back to buy at a lower level, but they will just abandon the instrument, even if they don't even go ahead to sell it.
Yeah. So the problem is that when you don't have proper advisory, right?
Okay.
You are going to make that mistake. So what advisory does for you is to help you to plan, set a goal. Because by setting that goal, for instance, if you are planning towards buying a home, for instance, that must be something you want to achieve by investing. So when you are guided, your advisor will sit down with you to be able to guide you to build that portfolio. While building the portfolio, of course, you create investment policy statements. That will guide you, that you can look at and say, okay, you stay disciplined over time. So when you stay disciplined within that period, then your behavior will be, all those behavioral issues will be moderated. Then you have instances where somebody is investing because what you call a home bias, right? Somebody is staying invested in Nigeria because even when things are getting bad, you are still saying that no, I don't want because I don't. But if you have proper advisory, right?
Yeah.
Your advisor can help you to be able to navigate that and moderate that your behavior, because these are behavioral issues that can make investors to not to realize the full potential of what they are trying to of their investment over time. So your advisors will help you to moderate all those behavioral issues so that you can stay invested. I know it's not easy, you understand, because within that planning period is when your advisor will have told you how much you need to be. If when you are doing your asset allocation, you have what is called a strategic asset allocation, right? That is your long-term goal. Then you have tactical plans, because you can have market disruption in between. So your tactical plans will help you to be able to take advantage of the market within that period. So you have been told ahead that, okay, this thing we want to do, if we are not meeting our target, this is the shortfall. You must have program contributions towards the goal you want to achieve. Because over time will come that if you are having a shortfall between your expectation and where you are, it means there is a gap. When you do your portfolio review, what you then do is to now look at it and say, okay, what do we need to do? Do you have buffer to do this, to make more control that you can achieve this target? Because in the long run, by the time you do the projection, you discover that in the long run you are still going to make. So within that phase, the advisory will help you to be able to navigate that, and all those behavioral issues, then you'll be able to deal with them.
So what I hear is that you can't go it alone. You need proper advisory to guide you whenever.
You can't.
Okay. Let's talk about risk tolerance now and time horizon, especially as people evolve they across different life stages. So the right balance between chasing returns and protecting capital changes dramatically depending on one's age, responsibilities, and proximity to major life goals. How do you balance, with the clients that you manage? How do you balance growth and capital preservation for clients at different stages of life? How do you approach this?
Okay. Well, you have to profile your clients, right?
Yes.
And their risk appetite, their risk tolerance, their risk tolerance varies, across ages.
Yeah.
So at your early stage, of course, even with the rule of thumb, the general belief is that you have higher risk tolerance, right? Sure. Because of your age, because you have a long period of time to stay invested, to also withstand the market volatility. So as you age, depending on what you are, as you age, of course, your risk tolerance will also drop. Your risk tolerance is a function of your ability to take risk and your willingness to take risk. So at the early stage, yes, at the foundation stage, when you are still building your marketable skill, that time you are marketing, then you have that's the growth stage. Now you are growing now. That stage, yeah. you are starting to earn money, you are growing, you are buying homes. At the early stage, at that growth stage, at the early stage of the growth stage, you are making money, right? But at the same time, your expenses are also growing. At the same time, you want to buy home, but at a point, your expenses will start dropping. So you pay, you have tuition fees to pay. You have other expenses to make within that growth phase. Then over time you go to the maintenance phase when you are now talking about retirement. So it's a function of your age. That age will help us to profile you. Then we look at you, and then if equity is recommended for you at that point in time, then you can do equities. But as you move along, then you begin to drop, some of these assets you are holding, then and be moving to capital preservation. There are many reasons why you want to preserve your capital. If you have a goal of, transferring your assets to your heirs, of course. If you have that long-term goal, over time, you have to build a portfolio that will be able to, protect that asset so that you'll be able to meet that goal. So these are things that can, inform the asset allocation as to whether you want more of capital protection or you want more of growth, right? So that's
okay. Yeah, let's. I think you're already talking about sustainable wealth now, extending beyond one generation to the other. And I agree with you that would require thoughtful planning. So when it comes to legacy planning now, how can individuals, families structure succession to transfer wealth across generations? Especially given the social instability and conflicts and some of these legal uncertainties that usually arise when, for instance, something happens to an individual and then there are challenges over the individual's estates.
Yeah, well, it's that legacy planning is in fact that's a very it's a very diverse, it's a very deep I mean it's an area that
Yeah,
is
I know
actually
I know
very,
it's broad.
yes,
Because
it's actually very, very broad. Of course, there are estate planning tools that you can employ, right? So you have the will. Your will is a planning tool, but you also have other tools that are more flexible than having a will. What I would now advise any individual to do is to die, I mean, without having a plan. Like I gave you that statistic the other time that about 72% of businesses don't even have any a business continuity plan in place.
those are structured businesses,
Structured
let alone
businesses,
individuals.
let alone individual that don't have, I mean, so but there are planning tools even for businesses. When what you see happening now is that you don't have that succession plan anywhere. And we don't have succession plan. Succession plan means you have, I mean, something like a family office. A family office is just an office. I mean, it's just like a private setting that helps an individual, to manage their entire family wealth in such a way that it will be sustained. I mean, between from one generation to another. So, but for individuals, of course, you can use this instrument of a will, or you have the trust. You can set up a trust for yourself or for the children, because the trust, setting up a trust is even more flexible than having a will. So when an individual dies in intestate, that is where the issues about the legal issues, probate issues, extension, and all those things, because of course they have to list all the assets. You list all the assets, they register, then you go to court. The court will have to determine, so many things, so many problems. You pay tax on it, and it will have to be registered. So the court will have to appoint an administrator. So these are things you don't want to. So if you start early, you want to ensure, you want to sustain, you want to really build that your wealth that
will transcend generations.
Transcend generations, so you can employ those instruments to be able to help you to. So, but when you work with an advisor, they will be able to tell you what you need to do, which one is appropriate for you at what point in time, and the common mistakes that people make, right?
Yes.
That individuals, investors make when they want. So you'll be able to navigate some of this, because if you are writing a will and your language is not the language you use in writing them are not concise. I mean, they're ambiguous. So you wrote it by yourself.
They need to be clear and non-ambiguous.
Yes. So when it now comes to implementation of the content of that will, you have a problem. So but when you are guided to do it, right, then you'll be able to do it properly. Then if you now want instrument that will help you to, depending on the goal that you have in mind, there are other flexible instruments that will even bypass the issue of probate or court, when the testator, dies, so at that point in time, all the provisions of that tools will become activated, and you set up that vehicle that can help you to transition your wealth from that generation to the other. So I think that
I understand. I know there are cultural angles as to why many Nigerians don't write will or even talk about succession planning and all that. But I think in the last couple of years, it's become apparent and obvious that even the wealthy needs to pay attention to all this, because death could come at any time. No one plans for it. But if it comes, you want to ensure that the wealth that you've work so hard to accumulate over time. It's not frittered away or, disposed to people who are not related to you or people who you do not envisage that they would have access to your wealth after your passing. But so as we begin to coast home now, if someone is listening now and they want to start building long-term wealth, what are the steps you would advise that they take?
Okay. Well, for anyone who wants to build sustainable wealth,
Yes.
the first thing for you to do is to build your financial foundation.
Yes.
Ensure that you have financial foundation. Well, the second one is if you know you don't have the time to do that because of course you have people that are not in the financial sector, people who don't have financial knowledge who are also wealthy because they have advisors, right?
Yeah.
They have mentors, most especially entrepreneurs. If you're an entrepreneur and you want to build, you want to build an empire, you want to build businesses that will transcend your generation. It means that you also have to have mentors. Learn from those that are ahead of you.
Okay.
Those guys can guide you, on what to do. Then you should also, your advisors will help you to put all those estate management plan in place. Then if it is business sustainability you want to achieve, of course, they will help you to put that in place because we have instances where you have individuals who have businesses. Those business don't move from to the next generation. The next thing is once they die, the business die with them. Then the next one is that train successors. Train successors. For instance, you are a businessman and you want it is not in all cases that you have to move the business will have to be run by your siblings, by your children after you have passed. You can create a structure that will outlast you, right?
Okay.
Create those structures that will outlast you. For instance, if you want to set up you want to make it a limited liability company, you have structures that can ensure continuity of that business. It means that the management is not dependent on you, right? So those structures will outlast you. Then beyond that, when you now leave, because if it's a business that you want your family values to be sustained, you understand? Because not everybody, there are some businesses, you look at some banks in Nigeria, they will tell you this is how we do business, irrespective of those businesses they have been sustained over time, government in,
Yeah.
government out. The reason is that they have this ethical inclination. They don't want to do business anyhow. Let me just put it that way. They don't want to be involved in any shady business where you have to. So you have some businessmen that want to maintain family values. So when you want to do that, you can have structure that can help you, like you have
To ensure that those values are
yes, those values
enshrined
are,
within the business
yes,
going forward.
they are sustained over time. So these are some of the things that you can do. Then have all the necessary planning tools for you to be able to to sustain your wealth such that over time it's your own case is not going to be you are not going to fall within that 70% who do not have any business continuity plan.
Continuity plan.
Yeah.
Okay, so finally, and I mean finally now, Adura. So, what is one habit people should start now, and one habit they should stop if they are serious about long-term wealth?
Yeah, if you are serious about long-term wealth, don't panic. when things go bad?
Don't panic.
Don't panic. So because when you panic, panic come from your emotion. So if you are emotional about it, of course, when you take any decision you make when you are emotional, might not be the right decision. So don't panic if you want to build any sustainable wealth, because over time, long-term wealth, long-term, anything long-term will deliver superior return. I will smoothen out any volatility in between.
Wow, thank you so much, Adira. It's been a wonderful time talking with you. I think, and I believe that anyone that I've been watching would have picked a lot of lessons, especially about building long-term. Well, the goal here is to continue to educate people so that they can take some of this advice and implement them for themselves, for their families, and for their businesses. So it's been my delight having you today on The Edge, Adura. And thank you everyone as well for watching. Please like this video, share with your community, and also consider subscribing to the channel. Until I come your way again next time, thank you, and we are out. Bye.